You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors, Mark Longo, Dan Passarelli, and John Critchley.
All right, everybody, that music means it's time once again for Options Bootcamp, the program where we break down the option strategies and tips and tricks that you could use when you're thinking about incorporating options into your own portfolio. My name is Mark Longo from theoptionsinsider.com, as well as from the ever-expanding, ever-exciting Options Insider Radio Network. 13 programs, a baker's dozen worth of programs available for you on said network. How do you find them? Well, pretty much wherever you find your favorite podcast programs, including, of course, our mothership, theoptionsinsider.com. That's where all of our great content flows from. You can find landing pages for any individual show that interests you, as well as listening and download and streaming information there, show notes, etc. You can also go to our homepage. The player there will stream instantly the most recent episode we've released on the network across all of our shows. If you're looking to find what's new, what's been posted today, maybe it's Dan's morning options news rundown, maybe it's one of our other programs. You never know. So surf on over to the homepage and you could stream some good stuff there and check it out. And of course, you can find us wherever you find your favorite programs: iTunes, Stitcher, Aha Mobile. Even you can, of course, paste the RSS feed into your player. And if you don't want to do any of that stuff, you just want to have it all ready for you on your device, we built a mobile app for you available in iOS, Android, and the Fire OS. No shortage of ways for you guys to download the shows, to stream them, to interact with them, and of course, to give us your feedback, your questions, your comments, your insights. We love to hear from you guys. And joining me on the old Options Bootcamp program, as always, the black hat to my white hat, the yin to my yang, the other Italian guy to my Italian guy. Yes, Mr. Dan Passarelli, the founder of Market Taker Mentoring. Mr. P, welcome back to the program, sir.
What's up, Paisan?
Yeah, two Italian guys. I should change the name of the show. Two Paisans talking options. They might have a certain appeal to a certain segment of the audience. I'm not sure. How are things going in Market Taker land, sir?
Oh boy, things are great. You know, we're winding down for the end of the year. Those of you who are listening, we recorded this at the end of 2014, the very, very end, pretty much. And winding down, doing some planning for next year. It was a really, really great year. Had a lot of brand new students join us this year, and looking forward to meeting some new students next year.
Well, you mentioned we are recording this at the end of 2014, so what better time, we thought, than to stray a little bit from our usual format and talk about some of the interesting lessons, some of the interesting takeaways that we learned from the year that was 2014 from an options perspective, as well as some interesting things you can take maybe into the next year, 2015. So without further ado, let's dive right on into a very special year in review segment, also known as our basic training segment.
All right, Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? Yes, sir. You're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Yes, sir. Pull in, prepare to learn. Yes, sir.
All right, everybody, welcome to the basic training segment. As you know from our past episodes, this is indeed the portion of the program where we break down some interesting options, tips, techniques, and strategies that you can employ in your own portfolio. And as we mentioned before, this is a little bit different episode because we are recording it. It's our final episode of 2014, and what a year it was from an options and from a trading perspective. A lot of interesting developments, a lot of interesting things to learn from and to apply in the new year. So I think without further ado, let's get started in some really interesting topics that caught our eye. Dan, you and I were talking before the show about some interesting things to kick things off with. And one thing that we kept coming back to, I know a lot of you guys probably want to hear, is given the year that we saw in 2014, a very interesting one, a predominantly bull market oriented year. We saw the market testing new highs on repeated periods throughout the year. A few troughs there as well, but mostly highs. And then some interesting macro events playing into the marketplace. Of course, the Ukraine earlier in the year, and then oil in the latter portion of the year. So a lot of interesting events really playing and wreaking havoc on the market in a wide variety of ways. It's interesting to look back at it and see exactly what worked and perhaps what didn't in the year that was from an options perspective. So Dan, perhaps we'll start there. When you look back at 2014, what really stands out to you as an option strategy that really worked given all the varieties of different conditions and environments we saw in the marketplace in 2014?
Well, the king of the hill last year for sure was put credit spreads. I mean, in general, and not in every stock, but sure was in a lot of stocks and with the broad markets. And as far as the things going on in the market, I mean, the rationale for why put credit spreads were so good is because of two reasons. One, the market kept going up. Put credit spreads are long delta positions that make money when the market goes up. Now, as opposed to something like buying a call, put credit spreads have limited risk, so they're good for slow, steady grinding it out markets, which is exactly what we had. The other thing is implied volatility was basically overpriced on average throughout 2014. That means options were expensive and option selling strategies like put credit spreads were the king. So it's kind of the perfect storm to take advantage of that positive delta, negative vega. And boy, I mean, I've seen even pretty novice traders, like students of mine who are brand new to options, doing pretty well because they were doing nothing but selling put credit spreads. It was an easy market to trade if you were an option trader. Yeah,
if you're one of those guys out there who likes to really fixate on a single strategy, and a lot of people out there do, even despite our warnings to the contrary here on this program, then you could have done worse than pick the put credit spread this past year. Let's do a quick definition for some of you who may be joining us new, maybe are not familiar with that term. It's pretty straightforward what he's talking about, of course. Essentially, you're just selling a put spread. The credit means you're collecting income to put that trade on. Usually that involves maybe selling an at-the-money put, buying an out-of-the-money put, maybe selling a little bit out-of-the-money put, buying a farther out-of-the-money put. You can construct these in a variety of ways, but those are the typical ways, typical vertical spreads that you're selling. And like Dan said, these are beneficial in a bull market environment like we had this past year for a variety of reasons. First off, they are indeed long delta trades, so the underlying rallies, you're going to do well. It's not identical to being long a call or being long the underlying, and you're not getting longer deltas as the underlying increases. You're essentially you sold that put spread, and that's your delta. But if the underlying rallies and you have a nice, long, slow movement like we had a lot of this year, and you had some generally declining levels of vol as the underlying rally, then this was a good environment for you to collect that premium and do fairly well on that. So it was an interesting strategy, and you're right. Certainly, if people did fixate on one thing, again, we don't recommend that, but if you did, then you could have done worse than focusing on the credit put spread or just selling put spreads in general. Now, of course, there's a variety of different ways you could build upon that. But I think before we even get into some other strategies, let's touch on the other point you mentioned there, Dan, which I think is an interesting one. And I think relates a lot to a very common misperception we saw that was very prevalent in the options world in 2014. And that was this notion that VIX, or implied volatility of the marketplace, was crazy cheap. It was just super cheap. We saw this drum beating quite a bit back when the VIX hit earlier in the year and the VIX hit about the 12 to 13 range. That's when it became very prominent. We saw a lot of people on there and CNBC and other outlets beating the drum for the long-term average of the VIX is 20, so it needs to rally. Again, a number I dispute. I don't think that's actually true, but c'est la vie. That's a conversation for another day. Still, saw a lot of people out there. The SIBO, of course, beating the drum for VIX has to mean revert, of course, trying to drive a lot of business that way. But in general, there are a lot of people out there, a lot of market pundits out there beating that consistent drum that volatility was cheap, And yet, what you mentioned, Dan, is a great point, that in the end of the day, that's what VIX measures, and what you're seeing in options prices, what we've said many times, is the implied volatility. That's the volatility level that the market guesstimates going forward for these options is going to be the most accurate. Again, it's just a guesstimate. So when you're making a guesstimate, you tend to factor in a little bit of a fudge factor, a little bit of wiggle room to make that estimate actually have some accuracy. So when you're doing that, you're going to essentially fluff up your estimate a little bit. You're going to have a little bit extra premium in there. And that's exactly what we saw in the marketplace. Even in those periods where the VIX's cheap histrionics were at their height, even in those periods, if you went and looked and did a search in a lot of brokerage platforms will allow you to do this, the actual vol in the marketplace. So either realized volatility or it's also called historical volatility. And you can break it down in a lot of different ways. Typical platforms will do a 10-day realized volatility and a 30-day realized volatility. If you look at those numbers during the periods when everyone was complaining that VIX was so cheap, you'll see the actual realized volatility in the marketplace, the 10-day in particular, was anywhere around, probably hovering around 5 to 6% in a lot of that time frame. So even though people were saying it is so lamentably cheap, this has to revert, volatility has to revert, it's not worth selling because it is so cheap, even though that was the common refrain, there still were opportunities for very selective premium sellers to do well. And even in those environments, when you have a discrepancy, what's called a risk premium, that discrepancy of implied volatility versus realized volatility is known as the risk premium in the marketplace. And you can see when the realized volatility is about 5 and then the implied is about 13, there still is about an 8-point risk premium built into the marketplace that you could capture if you are selling a selective strategy. So it's one of the big misperceptions that I wanted to address in 2014. And I'm glad you brought it up, Dan, because I was planning to get to it a little bit later. Is this something you saw a lot with your students, too? People coming to you saying, wow, VIX is so cheap, vol is so cheap, how should this address my trading? And then you break it down from a realized versus implied terms, and they actually start to understand it a little bit better.
Yeah, I think this concept that we're talking about here in terms of implied volatility is one of the trickiest things for traders to get. Like, people look at volatility and they look at a couple of things, and sometimes they don't take the thought iteration process far enough. Like, they'll say, well, look, implied is above historical. That means it's high, or below historical. That means it's low. Or, well, implied is lower than it used to be, so that means it's cheaper. But, there's more to the story. It's this relative cheapness. Like, I don't know, just to come up with a kind of maybe silly example off the top of my head. I mean, you can go to, I was at a trade show in Vegas about a month or two ago, and I brought some pens to give away, with the Mark Taggart logo on them. And we ran out of pens, lo and behold, but we needed pens. So I just said, hey, Amy, listen, go run down to the Walgreens and buy the cheapest pens you can find. And she came back with these really cheap, lousy pens, which is exactly what I asked for. God bless her. And she totally overpaid for it because she bought them on the Vegas Strip where, they're just price gouging. Now, to be fair, I don't know, she probably paid like 10 cents a pen or something like that, where they probably should have been 5 cents a pen. But, that's kind of a reasonable parallel to what we're talking about here with implied volatility. Like, right now, yeah, volatility is cheap, but it's overpriced. Just sort of like the pens were. Yeah, it's a lousy 20 cents a pen. I mean, it's not a lot of money, but they're overpriced. I should have been paying half that. So with the volatility, yes, because for a lot of 2014, the actual volatility, the historical volatility, like Mark was talking, the 10-day, was extremely low. Then yes, of course, implied volatility is going to come down and be lower, but it didn't get to as low as it should have been. And so even though you had the opportunity to sell cheap options, they were cheap, but they were still overpriced.
Yeah, that's a concept a lot of people have a hard time wrapping their heads around. Now, we're not saying that it was effective for everyone to go out there and just blast out premium regardless of the levels in the marketplace, because some products did get a little cheap, total overall perspective as well, not just from a realized and risk premium perspective. So you definitely need to pick your poison from an overall options perspective, particularly when you're selling. It's so tempting to just sell, hit that sell button. I know a lot of traders who get into that mindset. They can only sell options, and they'll force that sale regardless of whether the risk reward is really there. So make sure if you're doing it, you've done the analysis we've talked about. You looked at the historical vol, you looked at the realized vol, and you could tell that there is still a demonstrable value, a demonstrable risk premium that you could harvest by selling that option. Some related strategies, we talked about put spreads. There are a lot of different ways you could play off of put spreads, credit put spreads in particular, to your great effect. We've talked before on this show about a strategy called the triple income strategy, or the wheel of fun, or just the wheel trade. It involves legging into a strategy like this, starting off with the exact strategy you're talking about selling a put or a put spread as a way to leg into, get paid for entering a long equity position. And that certainly was a way to do it. And if you didn't get assigned the entirety of 2014, well, then you had to set a lot of income coming your way. You're getting paid to work a lot of orders throughout 2014, which is not the worst thing. You certainly would have been well off if you owned the underlying too, but still, having the put spread's not the worst thing. And then, of course, if you did get assigned, you had some underlying, chances are you had a product that probably rallied in 2014, so you probably were smiling on that front as well. And then if you did want to exit, which is the third part of the wheel trade, then, of course, you could have used a covered call to exit as well. Again, you had to be careful with the product and where you were writing that covered call, because all premiums are not created equal. All products not created equal. Some are demonstrably cheaper than others, and you don't want to sell implied volatility that is below the historical mean, for example, or things like that for that trading period in that cycle. But all those things considered, that's an interesting way you could take that strategy that we talked about here today that performed fairly well, the credit put spread, and add a few other components to it. So you don't have to worry. I know people sometimes worry when they're trading short options that they're going to get assigned, and what do I do with that underlying? This takes some of that worry out of the equation, because now you have an exit plan in terms of the underlying. You can sell the underlying itself, of course, or you can write the option, and if the underlying appreciates to the level that you want, you can then turn around and sell it out. Dan, what's your take on wheel trades here in 2014? Are you a fan of them, and what's your take on how they performed in general over the past year?
Yeah, over the past year, they ended up doing pretty well. My thing is that wheel trades where you start out selling a cash secured put or something to that effect, and then if you get assigned, then you roll it into a covered call. I think that's what we're talking about here, right?
That would be it, sir. Yeah.
So my thing with that is great for investors, which I think some of the people listening to the show are, traders. I think investors were the smart options investors were probably doing that, and they killed it. They did great. The smart option traders were doing put credit spreads, because they're a little shorter term, a little more nimble. They're not tying up all that capital with the stock. They don't actually want to own the stock. So either way, both of those strategies are positive delta, short Vega strategies, and that was last year was the perfect storm for either.
Now, the nice thing about what we were talking about before earlier with the credit put spreads as well is, remember, we've discussed on this show synthetics, listeners, and a lot of you out there are fans, devotees of the covered call. A lot of you, that's pretty much your sole go-to strategy. The short put, the cash secured put, as well as the put spread, the credit put spread, are both essentially synthetic ways of doing the exact same thing, as Dan mentioned, without the outlay of owning the underlying. Now, of course, the underlying portion was probably the best performing portion of all these strategies that we're talking about this year. So if you own the stock, it probably wasn't a bad trade to perhaps even mitigate some of your covered call sales and let the underlying run a little bit. But if you wanted to do covered calls and you didn't want to have all the cash outlay to do it, then that's another advantage of the credit put spreads, is you can do it and have a much more effective, efficient use of capital to do effectively the same thing on the other end of the spectrum. Now, again, I want to touch on some other misperceptions that we saw in the marketplace. We talked about some strategies that we saw that performed fairly well here in 2014. The other side of that is also true. A lot of people will look at the marketplace and say, oh, well, the S&P rallied X percent that year. Most of the major Fortune 500 companies rallied Y percent this year. Clearly, it was a marketplace where if you just went out and bought calls and put them away, you did well. And certainly in the macro sense, that is indeed the case. But I would caution people against really just embracing that wholeheartedly. Because usually when people are talking about buying calls, they typically mean out-of-the-money calls. And we've discussed this on the show in the past. That's a difficult trade to make profitable over the long term for a variety of reasons. First off, it's the general level of volatility skew we have in the marketplace means that those calls are essentially at a relatively cheap perspective if you want to buy them. So that's attractive. But as the underlying rallies, which as we saw happen a lot this year, that implied volatility level actually continues to decrease unless it's a very sharp, aggressive move to the upside. So you have these calls that you bought, but the underlying moves very slowly and kind of languidly in your direction like we saw happening this year in 2014. That actually is not ideal for that long out of the money call position because, again, you have that long, slow movement. You have the movement to the upside, which is causing implied volatility to decrease by itself. And then, again, you have this out of the money option, which is made up of nothing but time premium, so it's decaying very rapidly particularly as you approach expiration. So you have these two combinations. This theta is really working against you as well as the implied volatility skew. So you can have a scenario this year where you repeatedly bought out of the money calls every month or every quarter and still lost money because the long, slow moves of the market simply weren't rapid enough for that position to pay off. So I would just caution you, taking away from the year 2014, that the only thing you need to do is go out there and buy out of the money cheap calls and just put them away because you'll make money. And in some products, it certainly would work. The movements were sharp and aggressive enough. But in hindsight, and certainly all the trades we've made here at Options Insider and Dan and all of our people we've interacted with over the years, we've seen just how difficult it is to make that trade really pay off. So if you take away one thing from 2014, it's just don't go out and just load up on calls and you're done, because it's a much more difficult trade than that. That's why we've always advocated here on this show doing trades that are a little bit more expensive, but they give you a lot more bang for your buck. Like instead of the out-of-the-money call, we recommend the at-the-money vertical. So you buy the at-the-money, sell the out-of-the-money call, take advantage of that volatility skew, take advantage of the fact that you just reduce your overall premium. First off, that's a good thing. And then also give yourself a little bit higher probability of that paying off, have a little bit higher delta, have a little bit more of what you're paying for in terms of Greeks from that type of position. So it's a more difficult road, a little bit more nuanced road than you might assume when you just look at a stock chart of the S&P. Is that your take as well, Dan? What do you have to say to our listeners out there who are thinking, the market's rallying, I think it's going to continue rallying in 2015, I'm just going to buy calls and be done?
Yeah, I mean, the whole thing with option trading, as I think we've talked about many times on this show, is selecting the optimal strategy. Like, if you want to, I mean, I live out in the suburbs. If I want to go to Chicago and go down to the exchange, I could ride my bike there. I could take a rickshaw there. I could skateboard there, or I could drive there. I'm about 40 miles out. I think I'm going to drive. That's probably the best way to do it.
I would pay money to see the rickshaw, though. That'd be something. 40 miles in a rickshaw? That's a hardy fellow pulling that rickshaw.
Yeah. And, I mean, if you want to get bullish the market, sure, you can buy calls. You do call debit spreads, put credit spreads, back spreads. You can do lots of different things. But with some of them, you're going to be spinning your wheels and you're not optimizing your capital. And probably buying calls last year and probably going into this year is not the optimal way to do it. You probably do better off with strategically selected put credit spreads using the right strike prices, the right months, and what have you.
Again, that's what we always preach here on this show, a more nuanced approach to using options rather than just running out and swinging for the fences, loading up on out-of-the-money calls. Well, there's a lot to talk about here still remaining from. Let's hit on a few more interesting things that we think that we saw and viewed from 2014. Then we'll get into some 2015 items as well. I know a lot of our listeners want to get to as well. I think the corollary misperception to the one I mentioned earlier, that the vol or VIX was too cheap in 2014, was this perception that because it was so low, that options volume was going to be pretty much in the toilet for 2014. And what we saw was actually quite the opposite. It actually was a very robust year. We're recording this, listeners, on December 29th, so there still are a few more days to put in the old books before we put a stamp on 2014 from a volume perspective. But it looks like we are on pace to have yet another near or perhaps even record year, depending on how these final few days shape up here. But still very, very aggressive. Looking at the numbers from the OCC, which is, of course, the Options Clearing Corporation, they clear all of those trades that you guys execute, take the other side of them for you. And there was about 3.52 billion equity options cleared over this past year. A total OCC volume of about 3.9 billion, almost 4 billion contracts. Of course, that ropes in some other things they clear, like non-equity products as well as futures and others. So there's a bit of a mixture in there. But overall, some very, very high levels. ADV, for example, the average daily volume for the year was pretty much the highest on record, except for 2011. If you guys remember 2011, that was a record year from an overall volume perspective, and a record year for ADV as well. The ADV was about 18.1 million. This year we hit just a little bit over 17 million. So still demonstrably more than last year, 16.3 million. The year before, 15.8 million. The year before that, 2 years before that, 2010, 15.4 million. So from an overall volume perspective, it was a very, very, very robust year, which I think would be surprising to a lot of people who saw we had a kind of a wild beginning to the year with Ukraine. Then it kind of tapered off for the better part of the middle portion of the year. Then it came back with gusto toward the end of the year with October, and then the oil crisis really setting things off into the final third of the year. So we kind of had a bit of a bookended year with Ukraine in the beginning, oil, and October kind of at the end, and not that much in the middle, and yet we still did fairly well from an overall volume perspective. Dan, does that come as a surprise to you that the numbers are as strong as they were this year?
No, I mean, I think it makes perfect sense. I think part of the reason for that is it goes to what we're saying about smart traders optimizing their capital. I mean, like you said, yeah, if you own stocks, you did pretty well. And if you own stocks, I don't know, I'm not sure exactly what the final numbers are going to be for this year, but percentage-wise, sure, you did great owning stocks. But percentage-wise, with certain types of option strategies, you kicked it in the knees and then kept kicking it while it was down. You had a great year. I mean, you way outperformed simply buying and holding the stocks, and people are learning that. They're figuring it out that, hey, I can use really limited risk strategies, arguably risk less than I would if I buy the stock, traditional conservative buy and hold investing, and I can have a way higher percentage if it works out. So I mean, why wouldn't option volume have been really huge this past year? It was a great opportunity for option traders, and the proof is in the pudding. We see that, by and large, traders and investors alike went out there and traded up a storm. Options.
Yeah, you're right, but there is an environment a lot of people would traditionally think wouldn't be that favorable to options. I mean, we kind of debunked the too cheap from a vol perspective this year. I mean, there still was a risk premium in the marketplace, but overall levels of implied volatility were certainly on the lower end of the chart for 2014. So that usually isn't conducive to high options volume. Of course, beginning and end of the year kind of being the exceptions to that. And then you're right, we had a prolonged bull market, which historically, these days it does seem to be dovetailing into more people discovering options and things like that. But historically, that's always been well, hell, I'm not going to learn about these fancy, crazy, risky options things. I'm just going to go buy the stock because that works, So that usually has actually had the opposite effect. But this year, it seems like it has actually perhaps driven more people to embrace this product that you and I both hold so dear there, Dan. But some people out there may still be a little bit reluctant or reticent to embrace them, despite all the episodes we've done here, Dan, convincing them to the contrary.
Good. More option trading for me.
There we go. Well said. Well, we touched on a lot of things we saw in 2014, but of course we have an interesting year coming up as well in 2015. So it's maybe some interesting things we could apply there as well. Dan, maybe let's start off. Let's think about it from a couple of different perspectives. I mean, we kind of outlined already the strategy that we kind of liked, that we thought performed pretty well this past year, which was, of course, the put credit spread. It performed well for all the reasons we highlighted. Of course, the long delta, the steadily increasing market, the steadily decreasing levels of volatility as the market increased. So you were able to capture that when you sold those products. So a variety of reasons why that tended to outperform. So if we have another year in 2015, like 2014, of course, that put spread and the credit put spread, I should say, really will perform well again. But what about some other scenarios people may be interested in? Like, let's say we have a kind of just a relatively flat market, with not much going on for the entire year, not much volatility, not much underlying movement. Or let's say we have a slow, steady decline, maybe a slow movement in the opposite direction next year. We start to sell off, and we sell off not in the aggressive way, but we sell off in kind of a slow, measured pace. So we don't really see a dramatic increase, but kind of a slow, measured increase in volatility as well. Then, of course, there's that third outlier scenario, which is, of course, a very aggressive, very sharp sell-off in the marketplace, as well as a quick, aggressive spike in the volatility. In those three scenarios, what would you recommend for our listeners out there?
There are three very different scenarios, and certainly there could be permutations of each of those as well. Let's take scenario A here, where the market just kind of levels off. And that's a reasonable scenario. If the Fed is going to taper and they do it in a very, very controlled manner, we might not get a sell-off, but the market will surely stop rising because that's what's been driving the market for 2 years. Probably we'll see implied volatility start to come down even further, and it might get cheaper and it might not be overpriced at all. That would end up being probably the worst case scenario, because then if it becomes cheap and fairly priced, you can't sell options and you surely don't want to buy options. So I think that would be kind of the worst case scenario for option traders.
Yeah, that'd be a difficult one because you're right. There's no incentive to do either. So you're kind of just sitting on your hands. Volume drops. That's kind of a worst case scenario for everyone who's involved in the marketplace in that case.
And then just sort of a reversal of the slow trend that we've had for the past 2 years to a downtrend that's slow. That might honestly be the best case scenario, because implied volatility will surely rise some, because we typically see that inverse relationship. Stock market falls, implied volatility rises. We see it about 80% of the time anyway. And that sets up for a perfect storm for call credit spreads. The third scenario you mentioned, which all three of these are perfectly reasonable, is that we get a really, really hard sell-off. And, if the market gets spooked because of Fed tapering and maybe some political event coincides with that, and maybe we get oil shocks in the opposite direction and the Saudis decide to jack up the price of oil or something like that. There's many different catalysts that could lead to a sharp sell-off in the market. There will be an opportunity to make a lot of money in a pretty short period of time buying puts if you're really, really super nimble and you can get in on the action nice and early. But then typically what we see in the options business following a hard sell-off is you get that dead cat bounce and the market levels off, and then implied volatility just slowly ebbs and reverts to the mean where it should be, and options become fairly priced. And then you're in sort of a little bit of a lousy market too for option trading, because can't buy it, can't sell it. Same reason as scenario A.
Yeah, that's a mouthful. You've certainly dove into quite a bit there. But, it is interesting. There's a lot to build off of there. I think we'll start with one of the things you mentioned a couple of times, the Fed and tapering. And that could, of course, be a big driver in the marketplace next year. We're hearing the Fed talking about finally perhaps raising interest rates for the first time in quite a while, the better part of well over a half decade at this point. So it's an interesting thing to keep an eye on. And I think what's interesting for us from an options perspective, certainly you, Dan, as a diehard Greeks guy, is that it may actually bring back kind of the forgotten Greek to the conversation in 2015. If you're not familiar with what I'm talking about, listeners, we always talk on the show about Delta, Gamma, Theta, Vega. Those are kind of the four primary Greeks that we always talk about. But there is a lesser known, kind of overlooked stepchild, an addendum, a fifth Greek, if you will, that is Rho. That is your interest rate sensitivity in an options price. And you could see why we haven't talked about it a lot over pretty much the last few years on the network, because there hasn't really been a heck of a lot going on from an interest rate perspective. So Rho wasn't really a big factor. And probably, all things considered, Roe probably won't be a big factor in 2015. But if rates start to rise again, it may indeed become at least something you need to be cognizant of in 2015, which is why I wanted to put it on this list. We've neglected it for so long, but it does have value in certain scenarios, particularly, as you might imagine, listeners. So which products are really the most sensitive to Roe? Well, you're talking about the ones that are longer term, a lot meatier, more expensive options that have a lot of time premium, a lot of time value built into them. So the leaps and beyond tend to be the place you really look for Roe impact. So if you're like a lot of our listeners, you're focused on perhaps writing weekly calls or puts or doing some very near term 1 month, maybe even 2 months options, you're not going to see a large amount of Roe impact. They really, Gamma and Vega and Theta are going to be the things that really primarily, and Delta, of course, are going to really drive and impact your trading. But Roe going forward, if you're a longer term, maybe set in and forget it guy, you like to write one covered call and put it away for a year. Again, we don't advocate that, but a lot of people like to do that. If you trade a lot of longer term products, maybe you're buying longer term stock replacement calls and writing calls against those. So kind of that time spread option we've talked about before as a way to efficiently use your capital. Well, then of course this Roe may actually come back to bite you in the long term. Dan, are you looking forward to perhaps revisiting that oft overlooked chapter on Roe in your books in 2015?
Yeah, man, I actually wrote a lot about Roe in my books. Nobody reads those chapters because they've been pretty out of play for a while. But they weren't always out of play. I can remember there was, what was it, like a week period where the Fed changed interest rates by 75 basis points. It was 50 points in one day, and then 25 points, I think, was a few days later. Market makers like myself, we made or lost, 10, 20, 30 grand on days like that. So Roe is real. It's just, it hasn't registered on anybody's radar for a couple of years now, but it's real, and it's going to come back into play one day. I can't promise you exactly when, but it sure will one day.
Anything else you want to add? 'Cause I know taper is very much on your mind in the Fed. Anything else you want to add on the Fed/taper tip before we move on to some other takeaways or things to keep in mind for 2015?
Yeah, one of the other reasons why 2014 was a super easy year to trade for, like I said, even novice traders who were able to kill it as option traders, is because basically the government, air quotes, came out and told you what the market was going to do in advance. It's very much an oversimplification, but that's basically what happened. The Fed came out and said, we're going to buy securities, which is going to prop up the market. The market is going to go up for the foreseeable future. If you just listened to them, you took positive delta positions and you made money. The Fed has more money than God. If they want to prop up the market, by George, they can do it. They proved it to you. So now the Fed is saying, we're going to start tapering. We're going to stop buying as much securities, let's just say. So they're telling you that the market is not going to continue going up. You're saying, this thing we did that made the market go up, we're going to stop doing. So it's really, really, really important. I'm kind of segueing here into my 2015 thoughts, but maybe you can kind of take it from there and help us transition into that conversation.
Yeah, with the Fed perhaps easing there, and a lot of people are just concerned in general that we're pushing all-time highs in the marketplace. It might not be the worst consideration for you guys out there. A lot of you have long equity portfolios to start thinking about what to do in that scenario if the market does indeed turn. Dan did just outline, of course, some scenarios for kind of broad macro, but just in general, if you're worried about in the next 3 to 6 months some sort of adverse development in the marketplace, maybe a gap down, maybe a near-term correction, it probably is time to start thinking about some ways you can protect your portfolio using options, a smart hedge. To do that, I encourage you to go back into our archives, check out all of our episodes from our earliest days on about things like playing defense with options and put spreads and protective puts and all those kind of fun things. Collars, of course, very important from an overall perspective as well. A lot of people out there, long equity traders as well as financial advisors, like to use collars. Regardless of how you hedge, it might be time to start thinking about a smart hedge. Bear in mind, too, our rule of thumb when we've talked about hedging your portfolio. A lot of people have written in saying, hey, how much should I really reasonably expect to spend for decent protection? And again, it's going to vary by product, by the volatility skew in your product, by the implied volatility in your product. A variety of factors are going to impact this. But in general, a decent rule of thumb you can rely on is somewhere in about the 1.5% to 2% range of your portfolio you should be comfortable spending in return for decent near-term protection, near at the money, somewhere in a 3 to 6 month out time frame, depending on your product, puts or a put spread, if you want to mitigate that a little bit. So if that's okay to you, if you're acceptable to those ranges, then you should by all means be looking at perhaps buying some protection and putting that on and doing it in a risk mitigated way, like we said many times on this show, using put spreads instead of puts, using collars, et cetera, to offset the cost of that put. Of course, if that isn't acceptable to you, then maybe perhaps it's time for you, and if you're worried about some downside risk, maybe it's perhaps it's time for you to take some of that money off the table. That's perfectly acceptable as well. You had a decent year, take some of that off the table and put it to work, and at least wait for a correction and then go that way as well. We look at a lot of different metrics to kind of gauge the hedging interest out there in the marketplace. We talked about volatility skew many times on this show. Well, the CBOE does track that. They disseminate a product called the Skew Index, which tracks the skew on the SPX, the S&P 500 product out there that they list. And typically, it spiked as high as into the 140s very recently there on that risk level. Right now, it's inflated, of course. Puts are always going to be inflated relative to calls in the S&P, but it's not perhaps as high as you might think. It's hovering right around a 125, maybe into the 130 range, which shows that there is buying interest in those puts, but they're not perhaps as overpriced as they could be if a lot of people start stampeding into the marketplace and saying we really need to own puts right now. So that shows maybe there still is a little bit of complacency in the marketplace, still thinking about the near term is looking to the upside from an overall market perspective. But if you want people out there, and there are many of them out there, who think things may turn in the near term, it may be an interesting time for you to start thinking about how you're going to put on that protection. Again, verticals are a great way to do that, protect yourself against the near term, take advantage of that really, really steep implied volatility skew and the put wing versus the calls, so you can buy an at the money put, sell an out of the money put, and take advantage of that discrepancy there. Get some protection for a little bit cheaper than you would have be able to do otherwise, or you can do collars, things like that. But either way, if you have any concerns about the marketplace going forward, and hell, you're crazy if you don't have some concerns, then you probably want to start thinking about how to hedge. Would you concur with that, Mr. Passarelli?
Yeah, absolutely. I mean, just high level view of what you're talking about here. The smarter you are, the more money you make as a trader. So, knowing your fundamentals, knowing how to hedge, and then, being good at it, the details as to which months and which strikes and whether to collar or just buy a put and blah, 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 all that stuff. Review your fundamentals. The market changes. The market continuously changes. If you don't change with it, you lose money.
A couple other key takeaways here to keep in mind for 2015. We talked a lot about volatility on this episode, on this program in general. We don't talk about the vol of vol very often. People think of the underlying having volatility, the options have an implied volatility. But guess what? That volatility changes. And so volatility, by definition, has to have its own volatility. I know we're getting a little bit deep in the weeds, but it's true. It's the vol of vol. And this applies across the board, even to big volatility products like the VIX. The VIX is, of course, the volatility of the SPX options out there, the S&P 500 options. But that product will change on a regular basis. So if you're trading a lot of products that have a volatility component, and of course all options products do, or if you're trading a dedicated volatility product like the VIX or even SPY options, a lot of you like to trade those. Those, of course, have S&P 500 implied volatility baked into them there. It behooves you to learn about the vol of vol and how it can change. There are products out there that will track that for you. If you're looking at S&P 500, VVIX is one you want to consider that will show you how much the volatility of vol is actually changing on a regular basis. And you'll see if you look at a product like that very recently things were exploding. The vol of vol was exploding dramatically and now has come off quite a bit. And that's something that you should pay attention to if you're trading a lot of these products and going forward. That will impact how the spreads are trading in these products, how wide they are, the level of vol you can trade. A lot of things will be based off of that volatility of volatility. So that's a new concept for you. You might want to do a little bit more research into that going forward in 2015, because as we saw here just in the latter portion of 2014, volatility is very volatile right now. And so you want to keep that in mind if you're thinking about making volatility or volatility related trades. And if you're trading options, and you are here into the early part of 2015. Dan, anything else you want to add on volatility before we move on to some other final 2015 topics and takeaways?
No, I mean, I think we pretty much covered it without beating people over the head. You know, just because last year was easy doesn't mean 2015 is going to be easy. We have seen the vol increasing a great deal lately. You don't even have to know anything about options or implied volatility or anything to see that. Just look at volatility charts. The dips are becoming sharper and more magnified, and the rebounds are pretty quick and profound as well. The changes that we're talking about for next year are already in action. They're all like those wheels are already turning, and it's a machine that you can't stop. Volatility is increasing, adding some risk arguably to the markets. The fix is in for Fed tapering. The last I looked at the Fed funds contract, that contract tells us that traders are estimating July to be when interest rates may rise for the first time. So probably what we're going to see, my guess here, I don't do a whole lot of predictions on this show, but the first 6 months could be somewhat like we're seeing right now in the market, but with more profound volatility. And after that, all bets are off. Things are very likely to be very, very different.
One thing that's going to be the same going into 2015 is a topic we talked about on this show a few times over the past year. That is the concept of fragmentation in the option space. A lot of you who trade spreads have encountered this issue and have lamented it very aggressively to us and to others in the space. And unfortunately, that problem is going to persist into 2015. There are a dozen listed options exchanges right now. In Q1 of 2015, we expect the 13th to go online. The ISE will add its third exchange under its umbrella there. So if you're concerned about fragmentation, if you're having trouble getting your spreads filled, if you're being routed to the right spread book on the right exchange when those markets are actually relevant to you, then unfortunately that is not going to go away anytime soon. And probably the other thing I would add here as we're winding down our year-end show and looking to 2015 is that it really pays to expand your horizons and look at other options, pun intended. If you looked at the last third, particularly the last quarter here of 2015, the last quarter of 2014, you'll see that the most active product, the one everyone was talking about, the one that exhibited the most volatility, the most underlying movement, and a lot of the most surprising activity was certainly oil. And that's not one anyone predicted going into Q3 or Q4 of this year. So if you're diehard only looking at the Facebooks and the Apples and the Spies and a few other products, it may be worth starting to expand your horizons. If you've been lamenting about the relative dearth of volatility, if you're a premium seller and some of the products you're trading, you're not getting the levels you want, maybe it's worth looking at other asset classes like oil. To do that. And so it's a product that's exhibiting a lot of activity. Others throughout the year have done so as well, gold, corn, etc. So if you're limiting yourself just to equities and equity options, you're missing a wide variety of activity that is going on out there. You can play, of course, oil a variety of ways. If you're more interested in the broad sector and kind of playing energy as a whole, or oil, I should say, oil sector as a whole, then USO may be all right for you. I'm not a big fan of USO. It doesn't really move perhaps as you may predict. So if you're using it as an outright spec on oil, I would definitely stay clear. But more of a broad oil sector type play, then USO can certainly be a viable option for that, pun intended again. And then, of course, I definitely recommend if you're more familiar with the products to really, you want to speculate on Brent or WTI, then dive into those big futures options, because that's where you're going to get the most bang for your buck, the most liquidity. And if you want to outright spec on oil, and we're seeing a lot of people doing that now. Oil hit a 5-year low today, so we're south of the 60 handle in a lot of these products. You want to spec to the upside, you want to do verticals, whatever the case may be. Maybe you think it's going to keep going lower. Whatever your viewpoint may be, the options out there are certainly a viable product that you should consider, because it looks like this trend is not going to end anytime soon. So at least in the first part of 2015, you can expect more action in oil, and that's something you guys should probably keep in mind. So a lot of different things to really keep an eye on in 2014, a lot of things to think about as you look back on the year that was 2014. Hopefully you enjoyed the Options Bootcamp program. We certainly enjoyed bringing it to you. We're looking forward to getting the show on a more frequent schedule again in 2015 once we finalize all the deals we're working on here with the network to bring on more partners onto this program. We can bring it to you in a much more frequent fashion. But of course, Dan and I have done our level-headed best to really keep the show rolling and answer your questions. And really, you guys are really the reason we do this program, and we're very happy to do it. Dan, anything you want to leave our listeners with in terms of what you're working on at Market Taker, or any holiday wishes or looking forward to 2015? I will toss it to you now, sir. The floor is yours.
Yeah, well, we at Market Taker, we're looking forward to a really, really exciting 2015. Our students are gearing up for this year. This could be, for well-informed traders, this could be your best year ever. So we're really looking forward to that, and I hope you are too. We're here when you need us. You can always reach me personally at dan@markettaker.com. Market, like stock market, taker, like take something, 2 T's in a row. If you need anything, want to learn a little bit about our classes in general, feel free to email me personally, and I'll hit you back and tell you all about it and provide some guidance where I can. That being said, everyone, have a great 2015, and I look forward to providing you with some more thoughts and musings in future podcasts.
Well said, sir. Well, on behalf of Dan and, of course, myself, I want to thank all of you out there in the listening audience who downloaded and streamed and subscribed to our show, as well as wrote in 2014. You guys made it a banner year, and we're looking forward to an even better 2015 for Options Bootcamp. So we'll see you next year right here on the Options Bootcamp program.
Options Bootcamp is produced by the Options Insider, Inc. All rights reserved.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.